FinTechnology and Innovation. Please be introduced to your moderator for this event, Neil Barnsell, Head of Digital Transformation Americas, BNP Paribas. Round of applause, please. Followed by Hans Fleming, who's the former partner and co-founder of Amex Ventures. Gilbert Verdian, the CEO and founder of Quant Network. And finally, but not ultimately, your keynote speaker, Jules Miller, partner of IBM Blockchain Ventures and co-founder partner of Pros Ventures. Good luck, everyone.
All right, hello everyone, and welcome to our panel on fintech and innovation. So I know that, who was in the blockchain and digital assets panel right before this? Everyone? Okay, great, cool. So what I wanted to do, this is not a blockchain panel, but we're going to talk a lot about blockchain. You may have heard some of this before, but I have a slightly different take on the blockchain space. So I wanted to do a quick blockchain 101 and talk a little about is it real for the enterprise and especially in fintech. Then we'll do a quick fintech overview, and I'm going to end with 4 trends to watch. So I'm from New York, I talk really fast, so just fair warning in advance, I use GIFs, so this should be hopefully more fun than something that's not fun. I'm not going to trash anyone. Okay, so really excited to be here in Armenia for the WCIT conference. I think it's so appropriate that the power of decentralization is the theme here because blockchain is all about decentralization. Blockchain is a shared, replicated, decentralized ledger, and it builds on basic business concepts. The concepts, people have struggled sometimes to understand blockchain, but the concepts are very basic. So you have a business network of people you're transacting with or companies you're transacting with. You have the different participants who are exchanging assets between them. And then you have contracts, or in the blockchain world, smart contracts, that are the rules of how they transact. And the ledger is a ledger that has been around for thousands of years. It's just the system of accounting for those transactions. So blockchain, at the core of it, is pretty simple. So how does it work from a technical perspective? Magic, it's magic. In the spirit of Alex from Giphy being here, I'm using some fun GIFs. Okay, so this is really how it works. It's not that complicated. Someone logs a transaction and it involves some sort of digital asset or a digital version of a physical asset, and the transaction is broadcast to a variety of peer-to-peer network of computers. Then those computers, cryptographically, have some sort of consensus mechanism, and there's a lot of different ways to form consensus, and so I'm not going to get into proof of work, proof of stake, etc., but there are different ways to form consensus, and then once you achieve consensus, there's a new block being formed, and it's logged on the ledger in a way that is permanent, it's immutable, and it's there forever. And then the transaction's complete. So this is kind of very core basic blockchain. The thing I want to emphasize for those of you who are in the other panel or who only focus on maybe cryptocurrencies and public chains like Ethereum and Bitcoin, there are really 2 types of blockchains, and it's important to understand the difference. The one that people mostly start with is the permissionless or public chains, meaning the Bitcoin and Ethereums of the world, and anyone can join those. It's anonymous or pseudonymous, and anyone can view the transactions. You might not see what the transaction actually is, but it might be hashed, but you can see that a transaction occurred. And then tokens and cryptocurrency are required in public chains because you need to incentivize the network of computers to do the computing work, so the token or the cryptocurrency is there in order to incentivize those miners. Most of the time, at IBM at least, we believe that that is not necessarily appropriate for enterprise. So we started out working with Ethereum, and then we ended up creating Hyperledger with the Linux Foundation. It's all open source, so we focus mostly on Hyperledger. There are certainly other permission networks, but the difference with permission networks is only those with permissions can join. You know the real identity of the participants. There's no need for mining in tokens, although you certainly can have tokens. And then while the ledger is the same, and I'll show you a visual of that, I'm only able to see certain things. So I can't see what my competitors or peers are doing necessarily, depending on the permissions I have. So very simple landscape, just so you can kind of see what's going on here. So the crypto with permissionless or public chains are the Bitcoins and Ethereum of the world. There are no public chains that do not have a token, because you have to have a token in order to be on a public chain and incentivize those miners. The permission networks, there are cryptocurrencies or tokens specifically built on permission networks like Stellar and Ripple. And then there's several blockchains, permission blockchains that you don't necessarily need a token, like Hyperledger, which we work in, and then Quorum and Corda. So that's just a quick landscape. And just the visual that I mentioned here is that the problem is that when you're working in a business environment, you're doing business with a variety of people, and you're doing point-to-point transactions. And those point-to-point transactions are all accounted for in different ledgers. And so you see these like different books with different people. And so then if you have an issue, they could be, someone could be accounting differently than another person. There could be errors, and no one knows it until you have some sort of cumbersome reconciliation process. The solution with blockchain is that it's all on one ledger, so all of the ledgers are the same, and in a permission system, you only have access to see the stuff that you are available or are there to see. But the ledger itself is the same, and the same information there. So there's no reconciliations. It's really easy to audit, and it just generally works in a different way. So what's exciting about blockchain is it allows businesses to come together in new ways. It reduces risk. It can optimize ecosystems, so better, faster, cheaper, what all good technology should do. But then the exciting part is create new value where there's new businesses and new use cases that can happen on blockchain that weren't possible before. So, ta-da! Everyone understand blockchain now? Yeah? Okay. Woo! All right, got it. There's a lot more to this. I usually spend about an hour going into a deep dive with people who are new to blockchain, but this is a good resource. We have a lot of free things on there, like a Blockchain for Dummies book that you can download. There's a lot of videos and use cases and stuff, so feel free to go there and learn more. And what I want to spend 1 minute on is blockchain real now? So there's a lot of talk of this is very early, it's very nascent, like, we're not really thinking about blockchain is too far out, but I'm here to tell you that it is not. 66% of organizations around the world are already using blockchain in some capacity. The market is pretty large, so the numbers are big. I'm not going to go into it, but there's trillions of potential dollars of value coming out of blockchain in the next 5 to 10 years. And the thing around, this is a fintech panel, so the thing I want to mention is 25% of top global banks will be using blockchain by 2020. That's just in a couple months. This was a couple years old now. In my experience, and IBM works with about 98% of the financial institutions around the globe, it's more than that. I think it's at least the major banks are all experimenting with blockchain in some capacity, and some are using it very seriously. Not to plug IBM in any way, but just to give you the scope and the scale of what's happening. We have 2,000 people working full-time on blockchain. We've done more than 700 projects now, and have over 100 live networks. So this is very, very real. Okay, on to fintech. So just to be really clear about what we're doing here, fintech is just a concatenation of the words financial technology. So it's financial technology used to describe the new tech that seeks to improve and automate the delivery and use of financial services. There's a bunch of categories that go into it. It's a fairly large and diverse space. But what is exciting now is that the rise of fintech is pretty serious and very, very real now. It's always been a category there's been a lot of investment in, but in 2018, it was the largest year by far of fintech investment. 39 billion was invested in over 1,700 deals. That's enormous. And then there are 39 fintech unicorns valued at almost 150 billion around the world. So this is very serious, real companies, big money in this space. One of the things I want to point out here, though, is that somewhat unusual is that there are a lot of corporate venture arms investing in the space too. A lot of the banks, corporate venture arms, and then even broader than that. So about a third of the global fintech deals are including a corporate investor in some way, and 82% of the incumbents are planning to increase their partnership with fintech companies, whether through investment or through other partnerships. So this is an area where the startups are not necessarily trying to kick out the incumbents, they're really working together with the incumbents. And so I want to leave you with 4 trends. And you've heard some of these before. Uh-oh, it's going on a crazy, we'll go back here, okay. The previous panel talked a lot about cryptocurrencies, and we're not going to do as much here on that, but just like this is the natural evolution of money, right? Back in the day when paper money was radical, right? And then credit cards and like things like PayPal were very crazy. Like cryptocurrency is just the next generation of that. It will continue to mature and be more normal. What I think is more interesting, especially in the enterprise space, is tokenizing the existing capital market structure. So we're working with a really interesting company. So you can tokenize stocks, bonds, commodities. We're working with, as one example, a startup called Securitize, which is tokenizing corporate debt. IBM issues something like $13 billion of corporate debt a year, and tokenizing it makes it better, faster, cheaper. There's a lot of benefits to it. We're starting with commercial paper, but we're expanding pretty rapidly from there. Tokenizing assets for fractional ownership is really interesting. So anything of value you can tokenize in a way that you can cut it up into little pieces, and new investors can come into the market. So the picture on the left is Andy Warhol's, I think it's called 14 electric chairs. This was one of the first pieces of art that was tokenized. This allows people who might not be able to afford a Warhol get a piece of it as an investment. The same thing happened with the St. Regis in Aspen. That was tokenized. There was a fun story with the Plaza in New York where, if any of you watched the American version of Shark Tank, Kevin O'Leary was involved in that one, and it completely blew up and did not happen, but it was a really interesting and very high-profile example. I've looked at a lot of companies, startups who are doing stuff in this space. My favorite was comic books. I had no idea how valuable comic books were, but it's valuable enough to tokenize and fractionalize. This gives new investors an access to things they wouldn't be able to invest in before, and also creates another, more liquidity in the market. So tokenize all the things, all the things. Okay? Second trend is open banking, which is leading to the rise of RegTech. So new regulations around the world, but especially in the EU and UK, and we can talk about this a little bit on the panel, are requiring banks to open up their APIs to customer data. And this is good for the consumer. It increases consumer protection, but what it also requires is additional regulation and regulatory compliance. So the tech, and so here's actually a good landscape of a lot of stuff that's happening around the world. So not only are the tech startups need to comply with this, and there's actually a whole bunch of, there's a whole ecosystem of RegTech startups who are being built to create compliance for these things, but also the financial institutions are investing in and partnering in RegTech. So again, you can see the investment trends, more than double year-on-year investment upswing in RegTech investments. And what's interesting about RegTech is it incorporates all the buzzword technologies, right? So it incorporates AI, data analytics, blockchain, and robotics are all major parts of the RegTech ecosystem. And so it's a really interesting way some people categorize it as fintech, some don't, but I think it's part of it. It's a huge part of the ecosystem. Third trend is digitization. So there was a little bit on the other panel talking about land leases. This is one of my, or land titles. This is one of my favorite examples because it's so ridiculous, is that when you are doing things like mortgage-backed securities or HELOCs, home equity line of credit, in order to verify the authenticity of that land and the title, it's still a paper-based system for the most part. So when a bank or a fund is originating and securitizing a loan, they need to go to each individual county to get verification with a paper-based system of the land titles. So there's a lot of friction in verifying ownership, and it makes no sense. But the counties don't necessarily have the motivation to do this. So there's an interesting startup called Figure. The founder is Mike Cagney, so former founder and CEO of SoFi. And so they're doing HELOCs, home equity line of credit, and they have a separate company called Provenance that they spun off that is specifically focused on digitizing and working with the counties, each individual county, to digitize the land titles and to get them prepared to be originated and securitized as a loan. This is a lot of hard work, and it also shows that fintech is not just the financial services company. They've got to work with government, with startups, with a whole ecosystem of participants, which is great for blockchain and other new technologies. All right, the last trend is digital identity. This is a government example that we worked on with the state of North Carolina on a digital identity system, but I think it's a good example and shows you the power of a digital identity. So they were giving all government employees at first, and then eventually all the residents of the state of North Carolina a digital identity. For the government employees in particular, there was a lot of friction with logging into the variety of systems that they needed to log into to do their jobs. And so the digital identity prevented that friction, and you didn't have to remember crazy passwords and things that change every 4 months and all of that. Where this became really meaningful for them was in emergency response. So unfortunately in the US, this is becoming more and more of a problem where we have active shooter situations. And this is not something that happens every day, although it might seem like it in the news, but the government workers weren't logging into those systems that they needed to respond very quickly on a regular basis. So there was friction, and every second counts in these types of situations. And so there was friction in logging into the systems, and therefore it was leading to more devastation and more destruction. So with a blockchain-based identity system, it gives you those like critical seconds back. In the financial services space, the obvious example here is KYC. So know your customer, authenticating people before they do something like buy a security can be done in a way that's much more efficient than the current processes. We also did a project with the state of Delaware, where in the U.S. is where most of the corporations are incorporated. They were having issues where companies were issuing too many stock certificates. That they actually didn't have the right to do that. So when you tokenize when you create digital versions of the stock certificates and then put them on a cap table, you reduce the risk of over-issuing stock. And so we worked with them on that, and then with UCC filings for debtors. And then the last example is just proxy voting. So ensuring that votes are cast digitally are valid and tied directly to the owner of that vote or that share is actually a pretty big problem, and this is a really good use case for blockchain. So key takeaways are, in fintech in general, trust is really important. The adoption of fintech is about building and maintaining trust. In an industry that maybe sometimes doesn't always have the trust of the consumer. It's about collaboration between multiple entities, both the banks themselves or the financial services companies themselves, but also startups, regulators, and governments. And then I also see fintech and financial services as a bellwether. They tend to adopt new technology earlier than most because every little microsecond, every little improvement leads to real dollars. And so it's a good industry to watch to see what's happening because the rest of the industries and the rest of the economy tends to follow. So with that, thank you, and look forward to the panel.
Great. Thank you so much, Jules. I guess the book is called Blockchain for Dummies. I just want to make sure I got that right. Okay, great. Okay, so how's everybody doing out there? Good? Good, yeah? I know we have the time slot right before lunch, which is always my favorite time to try to get people's attention. But we'll try to do our best here. So I am the moderator for this panel. Actually, true story, I thought when I was going to moderate that I just got to ask these guys a bunch of questions and watch them sweat. But they actually want me to answer some of them as well. So that's the kind of panel that we have today. But it'll be fun. Just a little bit about myself. I've spent the last 8 years doing strategy and transformation work at 2 big banks. I actually started off my career as an investment banker doing M&A. So I think of myself as somewhat of a reformed banker by now. I went to business school, and then I spent a few years at McKinsey before I got into the banking sector. So I love this industry, and I'm very excited today to be joined by such experts in this field. And next to me is Hans Fleming. And I'll let him introduce himself, but a very interesting background. Also did some M&A, co-founded Amex Ventures. Hans, tell us a little bit about yourself and what brings you here.
Thank you, Neil. Appreciate that. Nice to be here. As Neil said, Hans Fleming, spent the last 15 years of my fintech experience at American Express in various strategic and operational roles, and in the last 6 or 7 years, worked in the M&A group and helped co-found Amex Ventures. So that's what's brought me here. I look forward to the discussion.
Great. Thank you. So next we have Gilbert Verdian, who is the CEO and founder of Quant Network. So what I know about that is he links blockchains together. So the guy really loves blockchain. Why don't you tell us a little bit about yourself, Gilbert?
Thank you. Hi, everyone. It's great to be here. My background has been in cybersecurity for 20 years, working across government mainly. And the last job I had was the Chief Security Officer of all the payment infrastructure for the UK, so keeping the pound safe on behalf of the Bank of England. And my interest in blockchain was really 2008 during the financial crisis. I was at Treasury and I saw the paper and it really interested me, and I introduced that to the rest of government, and the rest is history.
Great. Thank you for being here. Jules, I know you did your presentation. I don't know if there's anything else you wanted to add in your role as, at IBM.
So what I focus on is our partnership with startups. So I co-founded and run a group called Blockchain Ventures, and so we do 2 accelerator programs with Columbia University, and and then we also do a variety of startups with companies that IBM considers a small business, which is anything under 500 million in revenue. So as a 400,000 person, $80 billion company, that's still small. And so we look for the best enterprise blockchain companies in the space, and we figure out how to partner and work them through the IBM system and then go to market together.
Great. Thank you so much, Jules. So there's a lot of topics to cover. I thought we'd start with customer expectations. And customer expectations in this industry are very high. Customers want access to their information 24/7. They want a seamless experience. You want to be able to go on your browser to start an application, maybe finish it on your mobile app, and then even go into a branch to be able to talk to someone. And that all needs to be, again, a seamless journey. And so that's something that you really try to keep in mind in this industry. And I thought I'd throw to the panel first is, why do we believe the expectations are so high in this industry? What might be driving it? Is there something that's unique that might be helpful to understand? And I'll just throw that out there for whoever wants to jump in.
That's a broad question, Neil, but I guess what I ask is, if I were to look to the audience and ask for a show of hands, like who's really satisfied with your bank, or better question, who's dissatisfied with their bank? And go ahead. Who's unhappy with their banking relationships, or a little bit dissatisfied, or who has a lack of trust for banks? Mm-hmm. So, the thing that's so interesting for me about that is that when we talk about expectations, I think our expectations are set in the present. And if you look at the advent of technology over the past 10 years, there has been unbelievable change in technology. Yet a lot of the banks that have been working with technology for a long period of time have legacy technology that we've been working with for 20, 30, 40 years. So with startups, with social networks, et cetera, you can work with new technology and get immediate responses. With banks, I think the burden is a lot higher because what they're protecting for you is a lot higher. And so, at Amex, we had a lot of initiatives to migrate data from legacy platforms to new platforms. And what you end up with is a very slow process that you have to get 100% right, or you open yourself up to a lot of liability and a lot of customer dissatisfaction. And I think that's what can create an asymmetric situation for people that expect to have response time like you would do normally in the rest of your life. And in banking, just historically, it has to work slower, if you will. Yeah. And I think the opportunity for banks, of course, is to integrate new technologies to speed that up.
Gilbert?
Yeah, that's a very good point. From experience, we're a now generation. We want to watch and consume things now, whereas previously you had to wait for things to come to you. And so the consumer trends have changed, but the problem is banking hasn't adopted, and they're starting to, but they're hindered by legacy, they're hindered by regulation. And I could give you an example. HSBC in London, we spent £6 billion a year just to keep the system on. So there's a heavy legacy, a technical debt that we're all carrying, and it's very difficult for banks to try and innovate quickly, because if you touch something, it might break, and sometimes
yes.
No one knows what's happening within the environment. But then you see challenger banks, especially in Europe and in the UK, we have a lot of new mobile-only banks that have started from scratch. So they're not carrying any technical debt. They can actually do things quicker and faster. And the good news is the regulators have recognized the potential, and they've opened up regulation. They're allowing fintech to innovate. And we're seeing new challenger banks taking on the bigger banks, and they're getting more and more customers because the experience is a whole lot better. It's mobile. You never need to go to a branch. You can get what you want now from a mobile phone bank,
yes.
as opposed to a traditional bank, and that's happening.
Yeah.
I think this. Yeah. To me, I think this is a human problem, right? So you're the intermediary between a person and their money, right? And that is a weird place to be. And so there's a lot of high expectations, especially when something goes wrong, that can lead to the negative view of banks, both from a consumer perspective, but then also when you think of things like the 2008 financial crisis, there was a lot of blame put on the banks. I think that I think the thing that is maybe that people don't understand is that it is highly regulated for a reason. Regulation is meant to protect the consumer for the most part, at least in theory. And so they operate in a way that is actually a lot more credible and a lot more focused on the consumer than you would think, because there's not necessarily a human face to it. It feels a little cold, and there's not that kind of touchy-feely interaction. But in a lot of ways, the banks are there to support and protect the consumer.
Yeah. Yeah, I would say that it's always interesting to me. You see the fancy app, and then underneath it, if you actually look at it, it can be horrifying, because there's so many things that are being done manual and paper-based. And it's hard. I've seen with banks, you still have to get the day-to-day right? So banks are processing, settling billions, sometimes trillions of transactions, and you have to get that correct. You can't let that slip. And so how do you get that innovation and that change to happen alongside of that, which is a challenge, and we can talk about that. But I think that's one of the things that might be a little bit unique with all the legacy architecture and systems that banks have. I'd like to change the discussion a little bit to data, and you had this in your slide, Jules, and just explore about consumer expectations there, because especially in Europe, there's a movement where you're able to actually have more ownership of your data, and you can authorize third parties to have access to it, and you can monetize it, maybe sell it to a third party in exchange for something. Just curious for the panel, how feasible is open banking, and especially from a security standpoint, does it even open up some societal risk where you might have maybe poorer consumers who are the ones who are selling their data and the ones who have more money aren't? Could we see some kind of divide there?
Yeah, happy to take that question. So open banking is an initiative that really empowers Europeans and UK citizens to have access to your data. Traditionally, banks owned customer data, but now it's been regulated and it's law that you own your own data and you can demand and get your data anytime you want from your bank, and banks have had to adopt. And that's been great. So what's flourished is a new ecosystem of fintech where we're seeing TPPs, third-party providers, providing a gateway to your personal data and allowing fintech companies to build on top of these platforms. So what we've got in the UK is a lot of AI chatbots, a lot of budget tools, money-saving tools, where they actually authenticate you through the bank to your open banking data. And you can actually ask it, saying, how much did I spend on takeaway food in the last week? And it goes through your transactions. Or it could say, well, your utility bill, you can save £50 if you go switch to this provider. But with that openness comes risk. Yeah. And being in cybersecurity, people cannot protect and control their data in the same way that a bank can. Yeah. But at the same time, if you look at the risk that has happened and all the data breaches, the risk is just as high on the other end. So regulators are wary of the cyber risk with data and access to data. And we're doing a lot in this space with more regulation to make sure you're compliant. And so that's why the heavy burden of security, the heavy burden of risk and compliance on banks is to protect consumers, as Jules was saying.
Yeah. And do you see that spreading beyond Europe? Is that something that will become a norm, where your data is yours and third parties are going to be accessing it and we'll get the security right?
Yeah, I think so. I mean, Europe has kicked this off and it's been working. It's been a couple of years now. We're seeing regulation kicking in Australia that actually is doing the same thing. But, just a story, I was in the Federal Reserve in the Secure Payments Task Force, and I brought in a lot of European experience, and that's become policy now. So the Federal Reserve is changing its method and what it's supposed to be doing, and now they're doing transactions, they're doing real-time settlements, they're delivering service. And some of the ideas that are actually happening are open banking, access to data, open rails for innovation, and we're seeing the start of that policy being implemented across Europe as well. Yeah.
And related to data, I thought we could also talk about personalization, because that's a great benefit as well, because when banks have this data, then it helps them target better. It also provides a lower cost for them and a better customer experience. So you can do that through data analytics, and curious what you guys have done in that space or what you've seen successful.
Yeah, there's a lot of benefits. From a compliance perspective, you get to be able to treat and know your customer better. But also from a product perspective, banks and providers can actually personalize and deliver services to you. I mean, for an example, Hans used to work at Amex. Every time I use my Amex card in any country, within 30 seconds, I get an email saying, while you're in this country, try doing this. So the linking and the personalization of data gives me that better experience. And we're seeing a lot of new types of services being delivered to consumers.
Yeah, I'd like to comment on that. What I would say is if you talk about the important technological concepts we're going to discuss today, blockchain will be one. But when you talk about the kind of most important or compelling business concepts, I really do think personalization is near the top. At Amex, for the past 15 years, I've tried to do that in various roles that I've engaged in. And what that really comes down to kind of simplify that for you guys, think about it as kind of the right offer to the right customer at the right time. And I think all businesses need to be thinking that way, because it's really about customizing the product for the customer, if you will, and it's making sure that the customer gets it when they need it. Because we all, if you look at your email accounts, you're all being bombarded with marketing messages constantly. How do you as a company, when you think about your company, how do you show the right amount of restraint so you build the right trust and brand associated with the customers that you're trying to acquire, engage, drive loyalty for and maintain, so to speak, and personalization can really help that. And the kind of significant, what I would call wave of new opportunities for data. Jules mentioned it in her presentation with regard to kind of digitizing data, have given banks and also all companies many, many ways to increase, enhance, and improve personalization.
And you talked, Hans, about trust, and I think trust is a very important point, right? Financial services is struggling with that. It's one of the least trusted industries. If you read the research, it's getting a little bit better, but it's still amongst the lowest. So I wanted to talk to you, Jules, about that, right? Because is blockchain going to be the answer to that? And there are skeptics, who think of blockchain as a glorified spreadsheet, or there's a lot of trust that you actually have to have in blockchain. You have to understand the cryptography, the software protocols, and so how do I know how to audit it? So it actually seems like a black box to me, and so how is that the answer to transparency? Doesn't actually require me to trust even more something that I don't understand.
Do you trust math?
I was never really that good at math, but yes.
So I think it's a little more nuanced than that, but basically it's like, do you trust math and science and technology or people? And I think people have just more infallible issues. However, people are creating the blockchain technology, so there's also an issue of like, do you trust the platform that you are using for that particular use case? And so there's still you still have to select the right vendor, the right company to work with, who is building a blockchain-based system, which is inherently has more trust, but you also have to trust the people that build it.
So Jules, hold on, sorry, you're saying that we don't need to trust people anymore, that we can actually trust math and technology, and it might replace the need for me to trust somebody?
It minimizes the need to trust only people.
Okay.
There's still always going to be a person component, but the whole point of blockchain is it's also trust in institutions, right? If you have a blockchain-based network for the financial institutions, you're not putting your trust in any one financial institution, you're putting it in the consortium of institutions who are inherently checking and balancing each other. And so it facilitates additional trust, but there's the other layer of the human piece on top of it, it just minimizes that a little bit.
Okay. And I think you got to look at that two ways. There's do you, the consumer, trust your financial institution or your financial service provider? And does the financial service provider trust you, the individual? We made a few investments while I was at Amex Ventures in the trust the individual, kind of sector, which is about kind of verifying. And this is all about, once again, goes back to consumer expectations, because you guys want transactions, or we all as consumers want our transactions quick. We want them seamless, and we want our money now, but we also want it to be protected. So how do we as a bank ensure that you who are requesting your money or some sort of financial transaction on mobile, how do we make sure it's you? And there's a lot of ways to do that. And I won't go into too much detail, but there's some investments we made where they link directly with phone companies as well as other data service providers to make sure that your mobile is indeed linked to you. And there's others that have linkages to the behavioral aspects of your telephone. So meaning how you use your phone, how you walk with your phone to make sure you're human in a sense, as opposed to a bot or some sort of spoofing mechanism.
So Gilbert, I know you're pro blockchain, so I know where you're going to come in on this one. But maybe you can address a little bit on crypto, right? Because we talk about trust, and people haven't been trusting crypto. If you see, they don't understand it. They see all the volatility. Has that hurt blockchain adoption because of just the association with crypto? And what do you think we can do about that?
So I think right now we have a crisis of trust. The system that we're all using, the financial system, it's built on a legacy architecture and a legacy infrastructure that was actually designed in the 70s. And so we're building everything on a rocky foundation, and we're having the issues that we've had today. So if you look at what's happening with data breaches, threats that are constant, we see it every day, and we've kind of become decentralized. So right now we're in the middle of a revolution where we can actually re-architect this foundation for the first time. Finance and financial services has not had this opportunity since the 70s, when we moved from paper finance to digital and electronic. Now we're moving into a trusted, using blockchain, a trusted financial architecture. So what blockchain does is allows you to trust the network, because you can trust that the system is telling you it is X and that's true, and no one else can tamper with it. So it's allowing us to trust one another again, because before that, we couldn't. The crisis of trust meant we've given up our data, we've put it into all these companies' servers, data centers, and there's a breach, and you lose it. But now we can actually control the data and we can control the trust.
But Gilbert, hold on. So are you actually saying, though, I mean, we think about breaches, obviously, in financial services, what happened with Equifax and other industries such as Facebook. Are you actually saying that blockchain won't suffer from those kind of breaches? How can I trust it when I just look at the headlines in the news and it scares me?
The true story is nothing is 100% secure. I mean, the only secure the system is when it's off and not connected to anything in the world. So blockchain gives us better security, as Jules was saying, because you can trust the cryptography, you can trust the maths. How you implement blockchain is the same as any other technology. Is it a database or a mobile device? You have to implement it with security controls and the right controls around your implementation. So it does help us regain trust, but we have to do it correctly.
And just on this, there will always be bad actors. There will always be people trying to hack the system. I think the thing that is exciting about blockchain is that you can identify it and pinpoint it much easier. So in a permission blockchain network, if there are multiple nodes and one of the node owners gets hacked, you can identify that very clearly, isolate them off from the rest of the blockchain network, and then figure out what's going on with that particular system that was trying to be hacked. So instead of being one-on-one, again, it's a network, and you can isolate the issues really quickly. So I'll give a non-financial services example. We have a partnership with Walmart for a blockchain network called Food Trust, which is basically tracking the food supply chain from the farm to the grocery store shelf. And this is really important when you have things like E. coli outbreaks, whereas before they didn't know exactly where it came from, so there was, if there was an issue with spinach, they would just throw away all the spinach. Whereas now you can figure out exactly where it came from and only isolate the problem, whether it's a bad actor or an accident, whatever it is, and then it doesn't damage the rest of the ecosystem and the rest of the supply chain can continue on.
But Jules, question for you. So let's talk a little bit about accountability, because what if something goes wrong? Who do I go to? Because when you have an intermediary, you can go to that intermediary. So if it is so decentralized, let's say in a smart contract, something in the code goes haywire. Who do I go to, and is the code legally enforceable? So how does that work in the lack of an intermediary? And I can open up to either of you.
Yeah, happy to answer that. Enterprise loves decentralization, but they will never fully decentralize because of the risk and the accountability that you have to deliver the service, you're regulated by your regulators, and you're accountable to do that. I think what's going to happen is safe decentralization, where you actually put bits of your application, bits of your data on blockchain to help meet that particular use case, but other bits will be on a platform like a phone or a database or your website. And it'll be a combination of technologies that allows you to safely decentralize. But we're seeing the beginning of financial services adopting public permissionless blockchains because of better security. And we saw in the last 2 weeks, Santander did a bond for the first time on the public Ethereum because from their perspective, it was more trustworthy than having it on an internal permission blockchain.
Okay. The other thing is just that in a permission blockchain, again, so public blockchains are different, but in a permission blockchain, there's a governance board. So there is not necessarily a individual company that is responsible for it, but there will be either a governance board, sometimes there's a new company set up, and there are mechanisms to deal with issues that come up. Maybe it's more decentralized, but there's still a place to go to deal with the issues that come up.
Okay, great. Hans, I'd love to bring you into this conversation when we just think about strategy. So, so if we have less intermediaries, curious how you see what's going to happen with the banks. Could the banks become invisible, commoditized in terms of their interactions with consumers? And, let's just say I'm asking for a friend.
Wow, that's a loaded question. What I would say there is follows. I don't know any of you who attended the CTO panel yesterday here in this room, but I thought it was a compelling panel. I think they talked about how the computer used to all be self-contained, the CPU, short-term memory, long-term memory, all in one place. I think with the advent of technology and the availability of technology and the change of technology, what you're starting to see is kind of the entire computer, if you will, being in the cloud and you using each component of that from sometimes different service providers. But you still want to have a strong brand that you can trust, if you will. And I think consumers, at least in my generation, will default to that first. And that doesn't say that blockchain doesn't deliver on the service, on the service promise that it makes. But as a result, I think in the financial services industry, once again, when you're talking about something as important as your own money and your financial future, it is really important to have that trust associated with that. So whether or not, Amex doesn't create every service that it provides, but it is the overall warehouse, if you will, for all the services that are being provided to Amex customers. And so when as a customer that you have an issue, you know where you can go to have that issue resolved, so to speak. And I think that will be very important for the next 10, 20 years, even if the technology changes very, very quickly.
Sure.
And different service providers continue to provide different services.
Yep. Yeah, I mean, we could, in interest of time, we'll probably go on to another topic. I love talking about the strategic responses of banks, and it's something that I've spent a lot of time on because banks are trying to figure out, okay, how do you become more relevant and visible to your customers? And so, for instance, some of them are building these bigger platforms and trying to have a one-stop place where you can go and you can get advice, personalized research, self-service tools, and there's a big move towards that to try to have a little bit more of a platform. Not everyone can do that.
Yeah, and I do want to add one thing to that. It's not that the banks, want to stay rooted in the past. When you think about what we talked about earlier during this panel, is this kind of legacy systems. Well, Amex has them, Chase has them, international banks have them, right? But if you go look at the China consumer market, there wasn't as much of a spread of, let's say, credit cards throughout the entire, through the entire customer ecosystem. So it was much easier for them to leapfrog. So while banks need to work harder in the EU and the US and Australia to move their customers to new technology, I can assure you that they're spending the focus in doing so because everybody recognizes, even at Chase, I believe 75% of their transactions now are done online, so to speak, not in the branch. Chase recognizes that, and they're kind of marshaling resources to make sure they address that.
Yeah. Go ahead, Gilbert.
Yeah, if I can add, the disintermediation of banks is happening, and the barriers to become a bank are a lot lower today than they were 10 years ago, just from regulation. The regulators are opening up that walled garden, allowing for innovation to happen. And what we're seeing for the first time is technology companies that can be your bank. And I wouldn't be surprised if Amazon in the next 5 years is a bank, Apple is a bank. We're seeing that with the Goldman Sachs card, the Apple card that they've released. And utilities or phone companies can be your bank. So banks are going to transform and adopt to become service providers to other companies who can be the bank and the front interface to the person.
Yeah, it's a great, you just talked about innovation because I wanted to go there with the panel in terms of what you have seen as maybe some of the exciting innovation that's been out there that might be attacking some of the value chain for banks, whether it's in, could be in lending or in RegTech or other digitalization initiatives. Whoever wants to jump in there, but you've all been involved in different ways, blockchain and not.
So I'll just say, and actually just a tie into the last question is, the good banks are disintermediating themselves, right? So Goldman Sachs has more developers than bankers right now. So they really are a tech company, and they're not afraid to start doing projects that will cut into or that will cannibalize them in some smart way, in some small way, because they see the future and they don't want to get left behind. So the example I shared with tokenizing corporate debt, that is cutting into the bank's profit. If we're reducing the fees that we pay to the banks are making less money, but they're on board with that pilot because they want to understand it and they don't want to get cut out. And so they're trying to figure out new ways to think about the transactions that they do. And of course, they're trying to figure out how else they can monetize it downstream. But I've been very impressed with my work in the financial services space because they are less afraid than some other industries to disintermediate themselves.
So I want to add to that as well, on to Gilbert, your comment about, kind of Amazon becoming a bank. Well, first of all, believe it or not, they're already there in many ways. Maybe not a consumer bank, but when I was working on an initiative at Amex, which was really doing direct-to-merchant loans based off a merchant's cash flow that we would see on our credit card platform, so to speak. So customers would come to a certain merchant, they would charge some items or retail goods or something like that. The merchant would have a receivable, and they could borrow against that. So Amex was going into that business at a certain time. Well, as I started doing research into that more deeply, I saw that Amazon was already there. And the difference with Amazon with regard to its merchants is Amex might have anywhere between 5 and 50% of its merchants' businesses. But with Amazon's third-party marketplace, they have up to 85% of some of these merchants because they're the biggest channel. So just imagine that incredible data advantage Amazon has. I think the challenge for the big players to get into banking is the regulatory aspect. When I think about Amazon, and when I think about Airbnb, and when I think about Uber, and I look at their just exponential growth and how they're able to achieve that, some of that, for me, it's incredible technology, great consumer products, but it's also the fact that they were less regulated. Amazon, for when you purchased retail items on Amazon, you didn't have to pay a tax for a while. So you got a asymmetric and unfair advantage to shop at Amazon versus traditional. With Uber, the same thing. Uber drivers did not need to adhere to the same regulatory environment that New York taxi cabs did or London taxi cabs did. Yeah. So that creates that advantage. When Amazon and these others choose to go into banking, they will have to comply with bank holding company regulations. If they go direct into banking as the rest, and that would change the scope of their businesses. So I see them kind of continuing to run the edges of that, just like the merchant lending example.
Just shifting a little bit with time to maybe some of the other innovation that you've seen, maybe Gilbert, that you want to discuss that maybe some people here may not be aware of.
Yeah, I mean, what's really exciting me is we're in the middle of re-architecting the financial system, and we're seeing some things that were just unheard of years ago, and not that long ago. We're seeing a term called co-opetition. So people are able to cooperate with your competition to go to market because there's a new business model, there's a new revenue stream that you never had before, and it's really thanks to technology and the trust that it brings, and blockchain has been a component. The other thing that we're seeing is openness. So traditionally, the financial services sector and the whole system was closed. It was very, it was very limited to a select few that can actually operate on it. But regulators have come in and opened it up. And what we're seeing now, central banks are coming and directly being involved with central bank digital currencies because they believe and they see the economic benefit of allowing access to central bank money. If you look at the whole financial system, there is room to have a digital dollar or a digital pound to allow wholesale and retail intermediaries and retailers to benefit from accessing central bank money, removing the complexity of the system and allowing for growth. And that is super exciting. You can't imagine any central bank talking about this type of stuff less than 5 years ago, and now they're all doing it.
Yeah.
I mean, I don't even know how to answer that question because there's so much happening, right? Like 17.
What are you most excited about?
Obviously, blockchain.
No, but specifically, maybe some company or somebody who's doing something innovative that you'd really want to highlight, if there is anything.
Yeah, I mean, the two that I highlighted in my presentation, I think the trading of things, I think lending and trading in the financial space will be completely changed in the next 3 years. I think that things like, digital assets and tokenization are really, really interesting, and I think that will change the capital market structure entirely. And the fact that there are so many companies tackling it, like it's not just one company, it is an enormous amount of very smart, very driven, very motivated entrepreneurs, like 1,700 in just the last year were funded, and then many, many more who are not funded in the last year are tackling these problems. So there's, some will work, some won't, but I think just in general, the ecosystem is very mature at this point, both in blockchain and other financial technologies, and it's changing everything.
Okay. I'd also just maybe shift a little bit to what we're not seeing, some of the unmet needs. Maybe another audience question here. I mean, how many people here believe banks and financial institutions need to do more to help society? Is that do you have that view? So quite a few hands, right? And there's a lot of people who are unbanked, underbanked, don't have access to credit, and that's an issue out there. And for the panel, curious what your thoughts are on what financial institutions can do, for more greater good, what you've seen, and even if there's any examples out there that might be that we'd want to note.
Well, I'll think on the greater good answer, but I'll start with the underbanked piece. There's been a lot in the last few years to, create mobile wallets and things for those who have phones to be able to have access to their savings, so to speak, on their phones, who were traditionally, traditionally didn't fit into the banking system. And I think technology and as well data has really changed that, because when you look at where banks have been disintermediated the most, in my opinion, up to now, it's been alternative lending. And really what that comes down to is people, and I'm just giving America as an example, what banks do is they follow a historical playbook, which is what's your FICO score, which is kind of an indicator of how qualified you are for a loan, and then a couple other banking processes to determine whether or not you qualify. And if you're below a certain FICO amount, you automatically don't qualify. Well, this new advent of data has really enabled some of these upstart alternative lenders to come in and say, hey, look, we don't care as much about that data because we're going to take advantage of new data, social, behavioral, et cetera, to be able to offer you a loan that you wouldn't otherwise be able to get.
There's money to be made, right, in better underwriting.
I don't know if it's better because it's more expensive for the consumer. So you could argue that banks are just more conservative, but it certainly opens borrowing up to a bigger, kind of a bigger customer base. And then the social question you have to ask is, what interest rate is fair? If somebody is poor and they get a loan through an alternative lender that they couldn't get through a bank, but the rate is extremely high, is that appropriate for a consumer either?
And right now, a lot of the alternatives are really expensive. People going to payday loans and having ones that are really unfair. So I would imagine that gap can definitely be narrowed, in my opinion.
So I have an example actually that's in that space. So IBM, we have a partnership with a company in Kenya called Twiga Foods, and it's for inventory financing for food vendors. And most of the food vendors don't have bank accounts. And so we'll do micro loans so that they can buy more fruit and vegetables to put on their food stands, and when they sell them, they pay it back, and then they get a loan. This is done outside of the banking ecosystem because they don't have bank accounts, and it's typically benefiting women who are most of the vendors. And so things like this, again, it's a pretty solid business. It works. It's working and providing financing for people who are not in the banking ecosystem, and it's like just magical to see the difference that it makes.
Yeah. So we have about 5 minutes left, so I'm going to steer the conversation a little bit into investing and raising capital, because I think you guys can bring a pretty good perspective on this, and maybe there's some people out here who are looking to make some money in the industry or figure out who to partner with. So for me, when I look at the landscape, I don't know about you, but I just feel there's thousands of companies and they're all doing things, and they seem similar, and it's hard to maybe tell which companies have the most promise, and also that also has an impact when you think of partnerships too, because you want a good partner and you want a partner that's going to be there for the longer term. So what's important when you're analyzing some of these fintechs? What do you look for? What's critical? Just open it up to whoever wants to jump in on that.
It's all about the people. So as much as we were talking about all the technology and reducing impact on people for especially companies in the earlier stages, there are a lot of good ideas. It's 100% to me about execution and if you think the team can do it. And in the banking and financial services space, that's incredibly important because there needs to be a respect for the regulatory environment. There needs to be an understanding of how things work, especially in the bigger banking ecosystem that you're hopefully trying to disrupt. And you need to be partnering with your investors in a way that will form a good relationship. So as much as the technology works, and this is really hard with corporates, I think. It's one of the challenges I have at IBM. If you're not familiar with the startup world and you think, oh, this is a cool product, and I've had this conversation with people in the past, like, oh yeah, the CEO is a total jerk, but like the product is cool. And I go like, if the CEO is a jerk, that's a non-starter, right? Like you cannot work with that company because it's going to cause downstream issues. And that's something where I joke that I'm the translator from the startup world to the corporate world and the corporate world to the startup world because they don't necessarily speak the same language. And in the startup world, the people are the most important thing.
Great. Yes to people.
Yeah, 100% agree. And it is a bit of a cliche, but you have to have a solution to a problem that people have. There's no point creating a decentralization, something that no one's going to use, and the only thing that happens is some gambling application gets built on it. That does not help people. You need to identify what's the human problem you're solving in banking, in financial services, in non-banking, and the good news is you partner with the biggest players and they will listen to you. So for the first time, startups actually have a say in helping big corporates like the Amexes and IBMs of the world to solve that problem together because they recognize the agility and the innovation that startups bring. And this ecosystem is just built overnight. You're seeing this every day. Fintech is one of the biggest sectors around the world, and it's only going to grow.
Yeah.
Yeah, I think both of those are great comments. What I would say is you certainly need a diverse team, so to speak. When you put together your team, if you're looking to start a company and raise capital, one of the things we look at is let's look at the founders. Do they have complementary skills? The next thing, which I think is one of the most critical things, and Jules' comments about having the right temperament are even more important in the financial services industry, no question about it, because of the regulatory regime. And because of the regulatory regime, even if you're a non-regulated fintech startup, you still have to be able to provide your service and data at a barrier, so to speak, at a minimum hurdle rate that the bank can accept with its regulations. That's why that's so important. What I would say next is, for me, kind of most critical is that product market fit. And that's really, hey, there's a problem out there. Is your solution solve it better than we're already solving it? Because I can assure you the bank's already solving it, but what I've seen in all the investing I've done is that there's so many startups that have so many creative ideas that are just solving it better. New data, new et cetera, new approach, a new process, leveraging technology in a different way, and that is all important. So can you repeat it? How are you executing it is extremely important. And then how big is your market size? That matters not so much from the bank. If I like the product, I'm going to want it, but you're going to have to go out and raise capital, because if you have a startup for banks, a lot of times you're going to have a little bit more, you're going to have to hire a little bit more employees for, to manage your own company's compliance, so to speak, depending on the type of startup partner we'd work with. Sometimes I'd say, look, we'll pass on the A round, but we'll be back for the B, because you need to adhere to these specific compliance regulations that we have, and we know you need more staff to do so. But we like what you're doing. So
yeah. I would say probably that, echoing everything you guys said, sometimes companies aren't very clear on what problem they're trying to solve. What is that customer need? And it sounds so simple, but people mess it up. And also, I'd also say a change mindset, being able to be agile, think differently, shift gears. I find sometimes people are very fixed in the way that they want to operate. And in this environment, you can't be. You have to be adaptable, and you have to look at data and be willing to go in a different direction. And so I think that type of agility is missing in a lot of the companies that I see and in leaders, and I think that that's an important ingredient. We are out of time. I just wanted to thank our wonderful panelists. Thank you so much. You can try to find us. We love talking about this stuff, so you can find us around here. Thank you so much.